Let's turn to Sir John Gieve, who's former Deputy Governor of the Bank of England, was on the Monetary Policy Committee known as the MPC, and is now the chair of Nesta. Joins me now. Suddenly, everybody's talking about inflation, Sir John, and if you'll allow that we had, and you might disagree, but we had fairly calm financial waters for a long time. Why is it front page news? What does it mean to my listeners in their wallets and purses? Good morning, Sir John.
Hi, good morning. Well, the prices on average for the average household have gone up 5% and a bit over the last year, and that number's going to get worse. So the Bank of England have just said they expect it to reach 7% and a bit by the spring. And that's the highest inflation's been since about 1992, so for 30 years.
What does it mean to my listeners when they go to the shops, they go to fill up their vehicles or whatever it might be?
Well, they'll find things are more expensive. I mean, the main thing driving inflation in the last month has been energy, gas and electricity. And we saw massive increases yesterday announced for them to come in April. But actually, goods have been going up. Food prices have been going up, and there have been shortages in a lot of markets, which have led prices of goods to go up. So it's quite widespread, and that's been what's worrying the Bank of England. It isn't just energy, it's got wider across the economy.
What tools are at the disposal of the Bank of England to try and combat this?
They've got two main tools. One is interest rates, which have been pretty near zero now for over 10 years. But in previous times were usually in the sort of 4 to 5% range. So they can raise interest rates, and that penalises borrowers, encourages savers, and has an impact on the economy. And they've also, in the last 15 years, been building up what's called quantitative easing. They've been buying financial assets on a massive scale, 900 billion of them, and they could start selling them off. And what they announced yesterday was that they were going to edge interest rates up from 0.25% to 0.5%, and they'd start selling off some of those assets.
I read that we know that yesterday's decision was an interest rate lift of 0.25%, but I read that there was a school of thought for 0.5% or half a percentage point. Had you been involved, which side of the argument might you have come down on, Sir John?
Well, I think I would have been inclined to go for more. The bank has really been surprised by inflation. In November, they thought it would peak at 5% in April. Then in December, they raised that to 6%. And yesterday, they raised that to 7.25%. So inflation has been much more persistent and sharper than they expected. And they're worried, and I would be worried, that this will spread from energy prices and food into wages and across the economy generally. And once wages start rising to catch up with prices, you can get into a spiral which will require much higher interest rates. I mean, not 0.5%, but sort of 2 to 3% like we used to have. So that's what they're worried about. And the question yesterday was how much of a shock did they give markets? And they decided not to give it a big shock, but only just 5 votes to 4.
It's fair to say then that there will be, I would imagine, Sir John, there will be another rise quite soon.
I'd be very surprised if there isn't. And the markets now expect the interest rates to go up to, say, 1.5% by the end of this year. I think it could even go further.
To where?
Well, that's speculation. I think 2% is 2 to 3% is not out of the question. It depends on what happens to wages, which is why you saw the governor of the Bank of England yesterday saying he hoped that people didn't press for wages to compensate for higher inflation. If they don't, then that means we'll have a miserable 2022 with lower real incomes, but inflation will come down sooner. But if they do, if wages do rise to compensate, then we could face a longer struggle with higher interest rates.
You appreciate some of my listeners who are perhaps bouncing along the bottom find it a bit difficult to take Andrew Bailey's comments, which I'm sure are financially sound, take his comments when he's earning the thick end of £600,000, though, Sir John.
Yes, I can imagine people will think that. What he was trying to say, though, was that in the past, when inflation has really got going, as it did 30 years ago, as you and I will remember, it was because wages chased prices. That led firms to put up their own prices, and then you got a spiral developing. And he's really worried that could start happening again. As you said at the beginning, inflation hasn't really been a big problem for the last 30 years, so we've forgotten what it can be.
I remember as a young man, interest rates on my mortgage, 12, 13, 14%. Do you ever see us going back to those dark days?
I don't. That was exceptional. Those interest rates from the sort of 80s through to the early 90s were exceptional historically, and I don't see why we should go back there. And interest rates aren't like that anywhere else in the world. But on the other hand, having interest rates at 0.5% is also very unusual. Historically, interest rates for the last 15 years have been lower than they ever have been in history. So that's been exceptional too.
Just lastly, you'll be aware that the Chancellor introduced a package of measures to try and provide support specifically for those on lower incomes. How do you rate what the Chancellor put out or set out yesterday?
Well, it was a big package, 9 billion, which wasn't in the spending plans which he announced just a few weeks ago. Obviously, he faced a difficult question. I don't think he did target it particularly on the lower incomes. I mean, everyone, you and I are going to get £200, aren't we?
Yep.
And the 150 on council tax is pretty widespread. So he decided to help everyone a little rather than the poorest people a lot. That was his decision. It must have been quite difficult. But he faces some very difficult decisions still to come, particularly on public sector pay. If inflation is 7% in April, May, when the nurses, the doctors, the police, the armed forces come forward for their pay rise, is he going to tell them it's 3% as he intended, or is he going to put a bit on? So that is a really tricky decision that's coming our way.
Put your date in your diary. I'll come back to you then, if not before. Thank you for your time today. Sir John Gieve, who was former Deputy Governor of the Bank of England and sat on the Monetary MPC, the Monetary Policy Committee.